Hi, I'm Shiloh Bates, and welcome to the CLO Investor podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I interview key market players. Today, I'm speaking with Brad Larson, head of U.S. Global Credit Financing at CIBC. Brad is one of the bankers that restarted CLO issuance post the financial crisis, and someone I've done multiple transactions with. We discussed the opportunity he saw in CLOs in 2010, what creates a good CLO banking team, and why CLOs are easier to create today versus a decade ago. As you'll hear in the podcast, today Brad has more responsibilities than just CLOs, and Gabby Garcia runs the CIBC CLO issuance platform. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And if you're enjoying the podcast, please remember to share, like, and follow. And now my conversation with Brad Larson. Brad, thanks so much for coming on the podcast. Good to see you.
Absolutely. Shiloh, great to see you. Thanks for having me. This will be fun.
I'm sure it will be. Why don't we start off with your path to the CLO market?
Sure. It was a long and winding path to the CLO market, actually. I'll take you way back. I went to the Credit School at Purdue University. I majored in finance there. I always wanted to get into banking. Didn't quite get it done coming out of Cranard. So I took a little bit of a couple of year pit stop managing consulting in financial services. But I was working in Chicago at the time. I was determined to make it back to New York and have a career in finance. So I did a self-search a couple of years coming out of business school. Made it back to New York, was able to get a couple of interviews, and ultimately one stuck. I got an opportunity at Prudential Securities, and I was meant to join that next associate class coming out of business school. But because I was already out of business school and available, I got a call from Price Waterhouse at the time, and they were curious if I could start early. Because again, they knew that I was available. And Lisa, my wife, she was 5-6 months pregnant at the time. She hopped on a plane, flew back to New York, found an apartment, a 5th floor walk up in a 4th floor building. When I started my career in finance, it was a terrific opportunity. I was in the financial institutions group at Pru Securities. That's where I got my first taste of securitization. Loved the group, loved the guy that I was reporting to, a guy named Carter Rice, who ran FIG. But after about 9 months, honestly, pretty significant part of the group moved from Pru Securities to Credit Suisse, actually, to work in their securitization group. And Pru decided to demutualize and get out of banking. So I, fortunately, for a variety of reasons, which I won't go into, I was already having conversations with B of A, so stepped right into a specialty finance group at B of A Securities. But ultimately, one of the biggest clients at Pru, a company called Pegasus Aviation, which they finance themselves through the aircraft securitization market. They were an aircraft leasing company. Called me up. The guy that ran Pegasus, a guy named Rich Wiley, president of Pegasus, called me up. We had met at a dinner, honestly, my first week of Pru, and said, hey, I'd love for you to come be an internal banker. And that was my second experience with securitization technology, if you will, because again, that's how Pegasus financed itself. And ultimately went from Pegasus Aviation. That was January 2001. Went from Chicago to New York to San Francisco, where I'm from, where Lisa and I met at UC Berkeley in that Bay Area. We always thought we wanted to get back, but basically had gone from Chicago to New York to San Francisco in the span of about a couple of years. And then September 11th, 2001, obviously that was a horrific day. That significantly impacted the aircraft business. All of a sudden, Pegasus turned into a workout situation itself. I ended up that next year reuniting with a bunch of people at a company called American Capital Access, or ACA is what it became known as. And there I entered securitization from a buy-side perspective. But long story short, my start in CLOs started at Credit Suisse, where I joined in June of 2010. Honestly, before the CLO 2.0 market had restarted, I remember doing a interview at CS, and I ended up typing a white paper email on why I thought the CLO market would return. I didn't have many believers, obviously post-GFC at that point, because I lived through the GFC at ACA. But I landed at CS in June of 2010, and I was determined to help the market restart and help CS restart the business. And I did. We got our first deal done in obviously some internal approval stuff to get through coordinating with our securitized product sales force to get them on board with marketing our deals. But we did our first deal in May of 2011. It was an ING deal with Dan Norman and Jeff Bakaler. They became Voya, as you know, over time. And I will forever be indebted to Dan and Jeff, and Mark Boatwright was there back then, among others. That was the first deal. That was actually one of the initial 2.0 transactions that were done. Back then, we did our second CSAM deal in October of that year. In 2011, you recall this, when the market restarted, but it wasn't fully back. The market definitely wasn't believing. There were still investors who weren't buying the asset class. It wasn't until a few years later when I really feel like the market was back in a big way. And I remember people at CS honestly just doubting that it would ever come back. Oh, you're trying to restart a CLO. That's not going to come back. Too closely associated with CDOs. But here we are. 2025 is going to post the second consecutive all-time issuance. So it's definitely back. In fact, I think you and I, if I recall correctly, we worked on a deal back in 2012.
I think you're right.
But it's been a long ride. In June of 2012, I assumed the global head role at Credit Suisse for the CLO business. We had yet to do a European deal, but we were off and running in the US side. As I just mentioned, we actually did the very first European 2.0 transaction. That was in Q1, Q2 of 2013. That was a Cairn Capital deal that we did. And obviously that market's back. And I think people expect that market maybe to post a new record next year. And so it's been a long and fun ride. I think the market, from a people perspective, it's a great market, a lot of good people, a lot of managers out there. It's just a lot of fun.
Maybe too many managers, actually.
Maybe we'll get into that later. But that was a very long history of how I got into the CLO market. But like I said, it's been a fun ride. I'm not quite as close to the CLO market currently, but it's my roots and where many of my friends still work. So I'll always stay close to it.
So in 2011, when you moved to Credit Suisse and your goal is to restart the CLO market, I mean, back then, equity and even double Bs and triple Bs would have been trading at pretty discounted levels. So how did you see that opportunity, and what was the rationale for new investors to put in capital at par?
I thought of it more from the perspective of how important I think the CLO market was to the U.S. economy, frankly. It's how a lot of companies finance themselves. I never really thought the loan market was going to go away, though I'm talking about obviously the leveraged loan market. Pre-crisis, through the crisis, there was never really a problem with the loan market. Candidly, there was never really a problem with the CLO structure itself. Nonetheless, CLOs did get lumped in with CDOs, and certainly from a market value perspective, CLOs had some pretty big swings through 2008, 2009, even 2010. I thought of it less from that liability perspective and more from an asset perspective. And CLOs, part of that white paper back then that I referenced a few minutes back, CLOs are the most natural buyer for the loan product. So from that perspective, I just believed CLOs would come back. CLOs also ultimately performed through the crisis. So I just believed that there would be buyers for equity. There would be buyers for junior mezz. And you could find ways to make returns work. And I just felt like all constituents wanted this market to work. Certainly banks with their broadly syndicated loan groups and their leveraged capital market efforts, creating those loans for corporate America. They wanted loan product out there. CLOs were the buyer base. You had CLO managers that were getting paid for the assets that they were managing. CLOs were a pretty effective way for these businesses to scale their AUM. So they were certainly motivated to do it. And I just felt like there would be, coming out of the crisis, given that, again, CLOs ultimately performed, that there would be a buyer base to develop from a liability investor perspective. And that's really what I was counting on back then. It was a little less, does the ARB work? Are these structures going to work at maybe discounts on some of the junior mezz? It just felt like we would find ways, the market would find ways to compensate investors to be involved, because again, I just felt like there were so many forces that wanted to see this market return.
For CLO banking, there's a couple different roles. At a bank, there's the CLO banker, which was you, there's capital markets, and there's salespeople. Maybe could you just quickly hit the roles there and who's doing what when a new CLO is coming together?
back in 2011, there were only a couple of us on the desk at CS, and we were doing a little bit of everything. I mean, I was pouring through OMs, I was negotiating engagement letters and warehouse agreements, and I wasn't doing any of the real hardcore structuring that was done by, those more quantitative structurers on the desk. Sandeep Hoshing was my right-hand person back then. He's now at Barclays and had a long career at CS prior to that. But basically, you have teams that go out and help that originate the structures. That was effectively largely me and Sandeep as well, and a few others. We were going out meeting with managers, seeing if we could compel them to give us a mandate. Back then, it was a lot less competitive. There were probably 5 or 6 banks out there chasing that business. Today, there are circa 15 to 20. So it's much more competitive today. So it's part pitch, get out there and originate a deal. And I think everybody needs a hook to win a deal. Some people bring good loan products. Some people can buy AAA. Some people can backstop equity. Ideally, you have some hook. At Credit Suisse, we had a pretty active private bank buying CLO equity. That was a pretty compelling element to the business to convince people to give us a shot. Once you win that mandate, you usually have some combination of structuring people and portfolio credit analysts helping you sign up what's known as a warehouse agreement. It tends to be anywhere from a 1 to 3, potentially 5-year facility within which managers and / equity can start to build that loan portfolio to a point of critical mass at which you can start to market a deal and ultimately get it done. Then you have your structurers. Oftentimes, again, there's an overlap between the actual hardcore structuring of the transaction that's working with the rating agencies and your manager and your equity investor if it's not the same. And over time, your debt investor base, basically to create a capital structure that gets rated by typically one of S&P, Moody's, Fitch. Capital structures are typically from AAA through BB, sometimes single B, as you know. Again, you're creating oftentimes a semi-optimized structure, then go to once you kind of have a structure that works for the manager and the equity. And oftentimes there's a third-party AAA buyer involvement in the creation of that initial capital structure because some AAA guys might want a little more par subordination than others. And so you're always kind of playing around with things to see if you can create a structure that can deliver the equity returns to the equity investor in a way that's satisfactory to the manager to allow them to manage the portfolio effectively. And then once you have that structure, again, there's a syndication team that's working alongside of that. That's always sizing up where they think they can get bonds placed and at what level and so on and so forth. And that syndicate works the in-between structuring and the ultimate sales force that's going to work with syndicate and the structures to get the bonds placed. And usually you kind of have all sorts of different approaches out there in terms of some managers in equity like to run longer portfolios and access a little more of the primary loan market collateral. Other guys like to ramp lightly and do a little more of that approach that's known as print and sprint. You largely print the liabilities so you can lock in your cost of debt in the CLO structure and then ramp the portfolio quickly to make sure that you can hit the portfolio metrics that you've just modeled. But the process that we've always run at CS, and I know CIBC is still running this process, is usually one that tries to be in the market in and out as quickly as possible. We never really want to launch a deal and have it sit out there for 3 to 4 weeks. There's the potential perception that a deal is struggling, and that never helps your cause. And so we try to launch a deal pretty significantly placed so that we launch a deal, we wrap up the tranches, and we're out of market or priced within a week, max 2.
What do you think the key skills are to be successful as a CLO banker? I definitely remember being at more than a few conferences where you were picking up some award for being CLO Banker of the Year. Am I wrong?
No, I think that's right. I think that's in 1 or 2 instances. I think CLOs are interesting. I think of a team a lot like I grew up playing soccer and played soccer at UC Berkeley, Cal. That's where obviously I went to undergrad. I think of building a CLO team a lot like building a soccer team. Oftentimes, your 10 players on the field that a soccer team fields are not necessarily always the 10 best, most talented players on the team, but you need good strikers, you need good midfielders, you need good defenders, you need different skill sets. And so the thing is, most structurers have a pretty significant quantitative background. And I really think structurers are the unsung heroes in a CLO business. I really, truly believe that. And I think I said something similar on a Credit Flux panel many years ago. They're just really, really underappreciated. will do a great job on a deal. The structurers will work around the clock and model just a fantastic capital structure and do it quickly and without any hiccups. And you price the deal and all of a sudden I get the call or head of syndicate gets a call. Structurers really should get a little more credit for that. But you need quality structurers. Where I was going with this is oftentimes the issue with structuring is because it's such a grind and because it can be the thankless role. A lot of structures, what do they want to do? Once they have 4, 5, 6, 7, 8 years of experience, they want to make the move to the buy side or move into origination or move into syndication. And so it's actually hard to keep very, very talented structurers. They're critically important to the process, just like a specific player on a soccer field would be to the overall team, given that role that they're going to play. And so I think one thing that we always tried to do at CS, and one thing that I think we did incredibly well, learned from my experience at CS and was pretty heavily involved in the initial build out of this CLO team at CIBC, we really tried to identify lead structurers who were very experienced, who wanted to do that, who lived and breathed structuring. That's all they wanted to do. Sometimes we have to pry these guys off the desk to go to a client drinks or do a closing. Honestly, it's pretty funny. They're not really interested in that. They don't want to originate. They don't want to syndicate. You might sit back and think, man, in a perfect world, they would be interacting a little more with clients, the manager side or the investor side. And they do, to be sure. But I think we were able to do that incredibly well at CIBC. So I think what makes a successful, not necessarily banker, but group is building a team where you have people that want to be living and breathing what they're doing. So find those structures that want to be doing that. Find those syndicate people that are going to be comfortable, honestly, out interacting with the investor base and managers on a very frequent basis. That in itself can be a grind. They might not be in the office grinding away until 10, 11, or 12 o'clock at night, but instead they're out building relationships with clients. And that's really, really important. And you know what? Not everybody wants to do that. That can be a grind. So I think it's really about finding these people who want to be doing exactly what you have them doing. That doesn't mean there can't be a little bit of mobility and versatility, because there definitely is. But at their core, find those people where those roles are more natural for them. And then I think it's at CS, we were a smaller team. Obviously, we had a big, successful, good leveraged finance platform that was helpful. We had that private bank angle, which I mentioned, but both at CS and CIBC, I think we're relatively small compared to some of the bulge brackets. I think we've always punched above our weight from a productivity perspective. And I think that can be quite as simple as finding that right brand for that size, which tends to be, hey, we're not going to be the biggest, but we're going to be more hands-on. We're going to be more high touch with managers. Kind of like to think that back at CS, we started to do some of these mini non-deal roadshows before most of the rest of the market. So it's making the manager feel, and it's got to be credible, it's got to be genuine, making them feel a little more special. Whereas sometimes people are a little more focused on volume, and that's great. And obviously they're going to league table rankings, but we kind of like to play a little more in that middle of the pack type space. We did at CS, I think we do at CIBC, and I think we do it pretty well. We feel like those that are going to be out are going to be out a little more. Those are going to be in the office are going to be in the office a little more. Our hook is, when I joined CIBC back in June of 2023, I really felt like, Canada, we were seeing signs of Canadian investors showing interest in debt and equity. And I just sort of felt like, that's still a relatively untapped market. And CIBC is obviously, as a Canadian bank, has very good relationships there. And so that was part of our hook as well, is, hey, let's get people up in Canada as much as we possibly can to meet that investor base who I think on the margin are a little more compelled to be interacting with Canadian banks relative to some of the others. And let's turn that into a competitive advantage. And so, again, very long-winded answer to probably what was a simple question, but, it's a lot of the obvious stuff. But finding a hook and I think building the right team are two key elements to that.
So at CIBC, you guys have found a lot of Canadian investors that are interested in CLOs. Are they primarily playing up the stack in like the investment grade, or have you found pockets interested in equity and double Bs as well?
Honestly, it's all over. It's up and down the capital structure. I would say it probably leans a little more toward the junior parts of the CLO capital structure, but we have guys that are buying up the structure as well. It's literally up and down.
So one of the things that's always surprised me about our market is that so many CLOs form. Every week, more CLOs are coming to market and closing. But for each CLO, and there's 7 different classes of debt, and you have multiple investors in each class most of the time, and you have an equity investor and a manager, and all these parties need to come together and agree on terms. And a lot of times people's needs, desires work cross purposes. The AAA, they have a different agenda than the CLO equity investor, for example. So everybody in the markets, they're smart and they have maybe sharp elbows sometimes. So I've always been surprised at how often it is that a banker can force everybody into an agreement that works enough that the CLO will come to life, but probably everybody doesn't get exactly what they were hoping for at the end of the day.
It's gotten a lot easier in recent years, believe it or not. I mean, I remember back when you and I were doing more deals together back in 11, 12, 13, 14, the first 3 to 5 years, I remember I used to say it, honestly, I felt like every deal was a minor miracle to get done because the buyer base back then was just much more thin. And it was definitely deeper in the US. I remember in Europe, if you didn't have, especially really early 13 to 14, if you didn't have 1 or 2 key AAA investors involved, it was like, oh my God, how are we going to get our AAAs done? So that was never really the case in the US. But you're right, it's really hard. There are just so many moving parts in this CLO market. You have a manager that obviously wants to ensure that they have the flexibility to manage a transaction that allows them to express their style. So they don't want to be constrained by natural limitations that might actually impact their performance because they're not allowed to do what they want to be doing. Then you obviously have your equity investor that, yes, is likely going to have interests that aren't entirely aligned with your AAA investor. And then you have all your parts in the middle. And you layer on top of that you have a loan market that's moving every day. Honestly, it's gotten better in very recent years, but for many years, the regulatory environment was changing every couple of years. So layer that on a deal that's hard to put together in general. And then all of a sudden it's like, oh my God, there's a new regulation that we need to manage as well. And so I used to describe it a lot as what's an expression people use, like herding cats or whack-a-mole. You have 3 issues and you solve 2 of them and all of a sudden another one pops up. So you've got 2 more to figure out. I think this is where I'd like to think that this too is where by not taking on too many transactions, again, by focusing on a little more quality of the process and execution versus quantity, again, that volume game, I'd like to think that if you build the right team with the right people who want to be doing what they're going to be doing, and you don't take on too many deals, if you just have more time to spend on every CLO project that you do, hopefully you're running a tighter process and so can anticipate some of the issues that might arise. But the market has gotten more, first of all, the investor side has gotten significantly developed relative to 10 years ago. I would say generally docs have gotten a little more standardized, and don't ask me what, because I'm not as close to it these days as once what, but I think it's true. We just see you have more of your standard, what are known as STIPs or stipulations that investors, these are comments on the doc or needs in the doc that different investors need to see. And again, if you have a little more time to work on every deal, again, you can be lining up. That's where syndicate getting involved early. You have a deal coming up, the sort of manager profile that it is. You know the investors that want to be buying that deal. If you understand where their X's are and the demand that they might have, you already know, again, if you're running a good program or a good business, you know what STIPs they're going to have. You know how that's going to line up with your manager. And so this is where, again, having a little more time to really develop that knowledge of the manager, that working relationship with the manager, having that working relationship with investors, have a little more time to run a process, you should be able to anticipate a lot of these things. But yeah, there are a lot of different interests that exist in these CLOs. It's not the minor miracle that it was 10 years ago, but it's still hard. When an asset manager maybe gets a, whatever the type of institution it is, when they get a new allocation, they usually don't spread it out over a 12-month period. They find stuff they want to be buying and they put it to work. And this is where it's very important, again, to be staying, there'll be a theme to most of what I say, important to be staying in front of these investors because you want to know when they're going to be basically fully deployed. So you can go from literally 1 week, it feels like the investor side of the market is flush with capacity to 2 weeks later, they've spent it. So just managing through those situations can be a little trying from time to time as well. But again, this is where you need a team that's going to be tight with the market and tight with their process to navigate through it.
I remember once we were out a long time ago and we were having a celebratory drink. One of the CLOs we worked on was closing or had priced. And I said to you, I was like, oh, that really felt like an easy one. I guess it was maybe from my perspective, but you're like, man, none of these are easy.
I do feel like I used to say that a decent amount. It's rare that they're easy. I would say, broadly speaking, they have gotten a little easier in more recent years, but even you can run into these timeframes that are really, really tough, right? I mean, take earlier this year, markets wide open. We're coming off 2025 is going to be an all-time record year now, following up an all-time record year last year. Market got off to a pretty good start. Then all of a sudden April hits and we've got liberation, the tariff strategy and announcement that the administration made. And all of a sudden that threw the market for a curve. So it went from being pretty good market with good demand and relatively straightforward. All of a sudden, I think if you're out with a deal in that time frame, you probably struggled to get it done. So there's another example where it can be smooth sailing. All of a sudden storm hits and you got to figure stuff out.
So let me tell you how I approach investing in CLO equity and maybe give me your insight, because I think it might be different from some of the other folks that you work with. So for me, and you mentioned that the first CLO I did was with you. It took me like a second to even think back that far, but back then, that was 13 years ago. And I was just learning, I was just starting to invest in equity for the first time. And my boss sent me to two different CLO managers, and the idea was to choose one where we were going to invest $5 million or something like that. So I go to both managers. They're both some of the largest publicly traded alternative asset managers. And you meet a very seasoned credit team and everybody's wearing nice suits. And at the end of it, the boss is like, well, which one of these managers is going to do a better job on the CLO's loans? And I had to think about it for quite a while. And I was like, let me just be candid. I do not know which one of these top managers is going to do better than the other. But what I can find is CLO specific reasons to choose one deal over another. So CLO specific might be a lower management fee, better debt execution, maybe a loan pool that has less triple Cs or less defaulted loans, whatever it is. So that's how I've approached the market for the last decade plus. And we do a lot of work on the manager, and we have not a formal approved list, but there's the top quartiles who you'll find if you look in our schedule of investments. At least that's our view of the top quartile. But I feel like other CLO equity investors don't approach the market that way. I feel like there's 130 different CLO managers out there, and they actually have like really strong views. They'd say, hey, within this top 10 of CLO managers in terms of issuance, some person at the manager said something really smart in a meeting or something, and they're like really excited to do the deal. And they've chosen the manager. That's number 1, 2, and 3. And the CLO specific things are less important. Listen, you probably know my competitors better than I do, but that's how I think other people approach the market.
Honestly, I've always respected a ton how you've approached things. And again, it's been a while since we've done something together, but I remember doing a decent amount with you many, many years ago. And I've obviously tracked your performance. Keep doing what you're doing is what I would say generally. Here too is an interesting question. I'm not sure there is any one right strategy because it's all over the map. And I think it can be, whether it's right or wrong, it can be just they felt like a meeting went really well. Maybe it was a manager who gave them a little more time that day and was a little more respectful with how they answered questions relative to maybe the last manager that they met at the 45-minute speed date. From a primary perspective, I think guys are probably a little more agnostic from a secondary perspective because it could just be a mere function of price. Maybe they're buying a manager in secondary that they don't dislike, but they maybe don't love, but they're able to get it at a price that is a no-brainer for them. So again, I do think secondary maybe is a little bit of a different situation relative to primary. I think it's all over the place. I think some investors will look for those managers where they know they might struggle to raise equity, candidly. So they feel like they can approach that manager and get more of a fee share, for instance, from that manager. And maybe they can lock up that manager for the multi-deal package where they're getting that fee share. And that can be the top up, if you will, to get somebody comfortable to invest in that manager. I think there are some investors that want a little more demonstrated liquidity in a name that they might buy. Honestly, sometimes we've discovered managers that they're not spectacular, they're not bad, they're a little more middle of the road, but honestly, they might have a single or maybe even a program equity investment opportunity just by virtue of institutional relationship. They're a firm that's doing a bunch with the manager firms, and so they want to find a way to connect in other areas. Firm A likes CLO equity as an asset class, so hey, let's figure out if we can do something with that manager. It's kind of all over the map. Just think about these volumes and the equity that is required to get that volume done. And a lot of managers have captive equity, and so they're taking their own equity, and there might be slightly different reasons why those managers therefore are getting deals done. But there are a bunch of managers that need equity, and yet this market keeps going. I feel like I so often hear from the equity investor community, the arb is not working. How many times have you heard that? Over the last 15 years, I got to be honest, I feel like that's all I hear.
Well, nobody was saying that in 2021, to be fair.
That's true. Late 20, early 21, that was a very special time frame.
Bring that back.
But most of the market has not been that over the last 15 years, and yet all these deals get done. It's a couple of things. First of all, obviously, there are other economics involved, whether it's fee share, whether it's a portion of maybe warehouse fees or returns that are being contributed. There are a bunch of levers to pull to get a deal done. And the second point I was going to make is back to my original belief about the CLO market. So many parties want to see this market continue. That's another reason why I think stuff gets done. And I think banks are sort of incentivized to keep their warehouse book moving. They don't want that book building and sitting there for too long. So they're incentivized maybe to cut fee to get something done. As you know, oftentimes managers aren't earning a fee during the warehouse period. So they're incentivized to get a deal done. Your investor base, they want to get stuff done too. They've got capital allocated to this strategy. They want to get stuff done. Obviously, it's got to be on the return profile they've raised money for, but at the end of the day, they're incentivized to get stuff done too. So it goes back to my original thesis about why the CLO market was going to come back. You got a bunch of parties that want to see this market continue.
So one story on the manager selection is that since I've been investing in CLO equity, I've been a public filer, meaning all of my holdings end up filed with EDGAR, the SEC site, quarterly. So what I own is definitely not a secret. And once a CLO manager that I hadn't spoken with recently saw that I had bought one of their bonds, they're like, oh, you own equity in one of our deals. The implication of that was that we thought of them as one of the best CLO managers out there. But it's like, actually, well, no, we just bought that in the secondary and it was super cheap. And that's how it ended up in our book. It wasn't exactly the compliment that the manager was hoping for in that case.
That was my point about secondary guys can be a little more agnostic and just pick something up cheap.
So this year you mentioned it's going to be either the top year for new CLO creation or tied versus last year. What are the key drivers there, do you think? Is it CLO historical performance? And there's just a lot of money looking for a home across all asset classes, and we're getting our proportionate cut of that? Or is there anything unique to our market that's driving this issuance, do you think?
Well, you need demand across the board. Probably would be remiss without talking about some of the ETFs that have been formed over the last couple of years. The two hardest parts of the capital structure to place tend to be the equity and the AAAs. There's been good AAA demand, and that's been somewhat driven by the ETFs for sure. The equity demand we've already touched upon. It's an asset class that has performed. People invest in CLO primary when the returns in this structured product are attractive, at least if not more attractive than other similar asset classes, so that there's just better relative value in the CLO space. Obviously, they compare primary to secondary as well. When secondary is trading cheap, it's a little harder to get primary done effectively on the debt and vice versa. When secondary's gotten a little rich, people move to primary. I think what drives it, underlying credits. We've seen a little more downgrades this year, but default rates have remained in check. And bear in mind that the loan market default rates that you see aren't going to be the default rates you're seeing in CLOs, because CLOs are actively managed and should outperform the broader market. So you have an underlying fundamental credit environment that's supportive. You have an asset class that's performed. You have an asset class that on a relative value basis continues to look attractive to people. You have managers that want to be building AUM. I want to build AUM, so I want to get this deal done. I'll cut some fees. Let's keep this thing moving. You have banks that want to keep their book moving. Again, you have all parties wanting to see this machine continue. But at the end of the day, you have an asset class that's performed. You have a credit environment that remains solid in 25. It feels like it's going to continue to be solid into 26. because you have an expectation for rates to be a little lower next year. I mean, we'll see how that plays out, but I think the consensus is you'll probably see another rate cut or two in 26. You have an administration that's going to be supportive to M&A activity generally, probably a looser regulatory environment. That should be a tailwind for CLOs heading into 26. You just have a lot of micro and macro effects supporting the CLO market continuing to issue.
So we work in a market that's private in a lot of ways. I'm wondering, of the CLOs that were created this year, is your guess that the substantial majority of those had equity that just came from the manager in some dedicated fund for their CLO platform rather than true third-party equity investors like what I'm doing here at FlatRock?
Yeah, it's a mix. I mean, I would say probably the market is skewed to that captive equity, but it's not exclusively out there in the market. I don't have a great guess at what percentage based on our specific observation. Yes, I think it's more captive equity than third-party through true third-party deal-specific raised equity. But those situations definitely still exist. I mean, we've done several deals this year where, it was a manager bringing 51% of the equity. We had to get $49. Or it was a manager who was willing to take all the equity, but hey, they wanted to see if there would be demand for the equity in the deal. And so the team got out there and tried to raise some equity. And lo and behold, they actually ended up raising it all or a majority. So clearly the latter still exists. You still have deals that need to raise third-party equity. From a manager perspective, anytime you can approach a deal having the ability to take all the equity so you're not forced to sell down, that just obviously changes the power dynamics in that negotiation to some extent. But both types of deals are still getting done.
So you mentioned that at CIBC that you have responsibilities now above and beyond CLOs. What else are you working on?
My role is now I run what's known as global credit financing here at CIBC. Obviously, GCF is the acronym. GCF spans ABS, CLOs, residential credit, commercial real estate credit, private credit, and then we have a repo financing business as well. So it's the full structured product suite. When I joined back in June of 23, we were pretty regulative active financing bank in ABS. We did some CLO financing, both in mainly warehouse, I guess. We did some repo financing on CLOs back then. We did some private credit financing, mainly in CLOs and private credit. It was really as a financing syndicate partner. So we were a syndicate partner to other third-party bank-led bilateral facilities, whether it was a BSL CLO facility or a private credit facility. What we've built out here at CIBC is a little more of a pure play origination component to that. Certainly, we've added some structures across these different business verticals so that we can take that financing from its financing state to a securitization market term out transaction. I think what we talk about here a lot is across the verticals, we want to finance it, we want to structure it, we want to syndicate it, and ultimately we want to securitize it and trade it. And then that's the life cycle across the verticals. But as I mentioned earlier, obviously, CLOs will always remain near and dear to my heart.
Sounds good. Is there anything topical that we haven't touched on?
We covered a lot. I think it's going to be a really interesting 2026. It feels like we enter the year with a lot of tailwinds. I was saying this honestly earlier on a call. It always makes me nervous when you kind of enter a year that feels like it's meant to be as strong, if not stronger, than that previous year. I think just, again, focusing a little more on CLOs, the CLO market. Last year, it was, I think, $201 billion across BSL and middle market or private credit. CLOs this year, it's going to be, I think we're at 204 and change. I'm sure we'll probably see a few more deals get done this year. So whatever, call it 205 plus billion. I saw one bank a week or two ago with their 26 estimate for CLOs at 215 billion. Anytime we enter a year, again, with estimates exceeding that prior year, I do get a little nervous. You never know what's going to happen. And so we have to be positioned as a business across the verticals to lean into that potential growth projections. But at the same time, I think it's prudent to be prepped for sort of a what if the market isn't quite as open as we think. And so we've always, historically, I've always tried to go into a year prep for growth, but protected for the what if.
Well, I think one challenge for next year is just going to be that CLO equity this year, 2025, did not have a good return. So it's maybe flat or negative. I guess it depends on who you ask and what you own. But the reality is the loss rate on loans is elevated at a time where loans are also repricing tighter. And that's put a lot of pressure on returns. And each time a CLO forms, that's the first thing you need. Without equity, there's really nothing to talk about. So we'll see if bankers like yourself or your team there can put together profitable transactions that people want to sign up for.
That's absolutely right. Obviously, equities had a bit of a challenging year in 25. I think with some of these early calls in the market for loan issuance to be up, I think I saw somebody saying loan issuance was going to be double what it was this year. That's obviously helpful if it's true new issue, because one of the issues, to your point, you have had the issuance that's come out. You've had stuff repricing tighter. Obviously, I think that we'll still see some of that. But if you have more pure new issue, you'll have more new issue paper coming out with some OID. That's helpful to the CLO market. New issuance should take some pressure off the secondary market. Should be helpful too from a price perspective. Still might see a little bit of downward pressure on loan spreads, but I'm hopeful that some new issuance will actually be a little more of a green shoot for new issuance in 26.
My hope is that there's more loan issuance and that pushes loan spreads wider, or at least the refinancing of loans should decrease. And then hopefully with a lower base rate, we'll just see less loan defaults and more stable year for CLO equity. My closing question is always describe a CLO in 30 seconds.
A CLO is a loan fund with leverage, with active management.
Got it. Okay. That's what it is. Good stuff. Well, Brad, thanks so much for coming on the podcast. Enjoyed it and good to see you.
Yeah, this was great. Thanks, Shadow. Happy holidays.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any FlatRock Global Fund. Definition section. Payment in kind or PIK refers to a type of loan or financial instrument where interest or dividends are paid in a form other than cash, such as additional debt or equity, rather than in cash. A covenant refers to a legally binding promise or lender protection written into a loan agreement. Secured overnight financing rate. SOFR is a broad measure of the cost of borrowing cash overnight, collateralized by Treasury securities. The global financial crisis, GFC, was a period of extreme stress in the global financial markets and banking systems between mid-2007 and early 2009. Credit ratings are opinions about credit risk for long-term issues or instruments. The ratings lie in a spectrum ranging from the highest credit quality on one end to default or junk on the other. A AAA is the highest credit quality, a C or a D, depending on the agency. The rating is the lowest or junk quality. Leveraged loans are corporate loans to companies that are not rated investment grade. Broadly syndicated loans are underwritten by banks, rated by nationally recognized statistical ratings organizations, and often traded among market participants. Middle market loans are usually underwritten by several lenders, with the intention of holding the instrument through its maturity. Spread is the percentage difference in current yields of various classes of fixed income securities versus Treasury bonds, or another benchmark bond measure. A reset is a refinancing and extension of a CLO investment period. EBITDA is earnings before interest, taxes, depreciation, and amortization. An add-back would attempt to adjust EBITDA for non-recurring items. LIBOR, the London Interbank Offer Rate, was replaced by SOFR on June 30th, 2024. Delever means reducing the amount of debt financing. High-yield bonds are corporate borrowings rated below investment grade that are usually fixed rate and unsecured. Default refers to missing a contractual interest or principal payment. Debt has contractual interest, principal, and interest payments, whereas equity represents ownership in a company. Senior secured corporate loans are borrowings from a company that are backed by collateral. Junior debt ranks behind senior secured debt in its payment priority. Collateral pool refers to the sum of collateral pledged to a lender to support its repayment. A non-call period refers to the time in which a debt instrument cannot be optionally repaid. A floating rate investment has an interest rate that varies with the underlying floating rate index. RMBS are residential mortgage-backed securities. Loan-to-value is a ratio that compares the loan amount to the enterprise value of a company. GLG is a firm that sets up calls between investors and industry experts. A risk retention fund is a third-party fund raised by CLO managers to comply with the CLO risk retention rules. The U.S. CLO risk retention rule was introduced in 2014 under the Dodd-Frank Wall Street Reform and Consumer Protection Act, requiring CLO managers to retain not less than 5% of the credit risk associated with each of their CLOs. In 2018, the U.S. risk retention requirement reversed for BSL CLO managers after being successfully challenged in court. LME stands for Liability Management Exercises, which are strategies often used by sponsors or select lenders to restructure debt obligations of distressed companies in order to avoid traditional default proceedings. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential, or actual portfolio changes related to securities of those companies unless otherwise noted. All discussions are based on U.S. markets and U.S. monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the view of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice. Act as an impartial advisor or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com.